Hello, everyone. Welcome to the Financial Synergies Wealth Advisors webinar covering the One Big Beautiful Bill Act. We have had a ton of interest in this topic. We've had lots of client questions about what's in the bill, what's not in the bill, how's it going to impact me, and so we really wanted to talk to you about that today. My name is Heath Hightower. I'm a managing partner here and senior advisor for Financial Synergies. I'm joined with Brian Chisha, Will Goodson, and Rachel Buckoff, all partners and financial advisors here at Financial Synergies. But I also wanted to introduce the newest member of our team, Matt Oftenspring. Matt's going to guide us through the discussion today. He is the newest member of our team. We just hired him as the director of marketing for Financial Synergies, so we're super excited to have him. He's not new to marketing, but he's new to the firm. So, Matt, welcome to the team. Take us away.
Thank you, Heath. I really appreciate it. I'm so incredibly grateful to be here at Financial Synergies, and I can personally attest to the momentum that we've had for the growth here of the firm. As many of you know, the One Big Beautiful Bill Act was recently signed into law in July, and this is one of the biggest tax changes that we've had in years. So we're going to dive in, give you our perspective, talk to you about how our financial advisors are going to prepare a game plan for you and really tackle some of these topics and how it's going to affect you. So I'm going to go ahead and start with Brian. And Brian, what have you been hearing from clients about these changes?
Yeah, there's a lot of buzz around this bill, certainly. And I think the biggest questions that we've been receiving really have to fall along the lines of what's changed and what hasn't changed. There were so many aspects of previous tax legislation that were set to sunset or expire, and the One Big Beautiful Bill Act extended and made permanent a lot of those sunsetting provisions. So one of the questions that we've gotten a lot is, again, what's changing and what's not changing. So we'll definitely get into that together today. And ultimately, I think what people care about is, how does all of this impact me? And so we're going to cover a really broad range of different aspects of this bill, ranging from young families to retirees, people who have student loans, people who itemize deductions, people who take the standard deduction. There's a little something for everybody that we're going to go through together today. So eager to get going.
Yeah, I think you're exactly right, Brian. That is really the big takeaway, I think, is that not a lot has changed, which is great news. But the questions that I'm getting, I don't know about you guys, but the questions that I'm getting is what has changed and what hasn't. So I want to talk a little bit about that. I think the best way to talk about that is to kind of go back in time, back in 2016, when the original tax cuts were made. The Tax Cuts and Jobs Act of 2016 went into effect 2017, is really where I think the story starts. They lowered tax rates, they increased the standard deduction, they actually limited the state and local tax deduction to $10,000. The estate tax exemption was essentially doubled. So much changed back in 2016, 2017, but it was all set to expire in 2025. So there's been a lot of tension leading up to 2025, a lot of changes anticipated, but we just haven't known what those changes were going to be until now. July 4th is when this bill was passed, and so now we know, and we want to talk about that. Number one, the standard deduction increased just a bit. The standard deduction for married filing jointly was $30,000. It increased just up to $31,500. Same for single. The single was at $15,000. If you're filing single, that increased up to $15,750. So that's a net benefit, not a huge change, but certainly something worth talking about. One of the biggest changes I think that's gotten a lot of talk is the SALT deduction. Many of you probably became aware of the SALT deduction last year when it was limited to $10,000. Many of our clients had SALT deductions in the past that might have reached $40,000, $50,000, $60,000, or $70,000, and of course now that has been capped to $10,000. The Big Beautiful Bill changed that. The Big Beautiful Bill increased the SALT deduction from $10,000 all the way up to $40,000. So maybe not as high as a lot of our clients would have wanted it to be, but $40,000 is certainly an improvement over $10,000. But with one one caveat, there's always a caveat with the tax break. And in this case, it's limited. It starts to phase out with income, adjusted gross income above $500,000. And that can be a real problem for a client that is making significant income. So between the phase out starts at 500,000 and ends at $600,000. So that's a pretty aggressive, pretty steep phase out that we're going to be really focused on over the next few years as we create financial plans for our clients. Anyone that has income right at that $500,000 level should probably focus their efforts on trying to minimize the amount of income so that they don't bump into that decreased SALT deduction, which is so valuable. The big question that I'm getting, Brian, Will, I'd be interested to hear what you have to say, and Rachel. But most of my clients are saying, how do I stay out of that? If I'm right at $500,000, how do I stay out of it? And there's not a ton that you can do, but there are a few things that we can focus on. They're called non-itemized deductions, and things like 401k contributions, SEP IRA contributions, which can be significant, can really help kind of bring you back from the ledge there. Same with health savings accounts. Any of our clients that have health savings accounts, those contributions are tax deductible, and can lower your adjusted gross income. And same with capital losses. One thing that we tend to focus on towards the end of the year is what we call tax loss harvesting. And so if we do have any losses in the portfolio, we can offset those losses against capital gains, which can go a long ways, especially if they're for our clients that have large after-tax accounts. So those are just a few ways that we can keep our adjusted gross income lower to try to stay away from those SALT deductions.
As far as mortgage and auto, there's some new deductions there too. Talk a little bit about how that's going to affect folks out there.
Matt, that's a good question. And I think the most important aspect of the mortgage interest deduction is that it just didn't change. It does impact almost all of our clients, so it's really important. It remains at $750,000. You have to itemize to get it. So that's an important, anyone that takes the standard deduction doesn't have the opportunity to deduct that interest. But up to a $750,000 home will enable our clients to deduct that interest. And then maybe one of the most fun things to talk about that's new and I think unique is the auto loan interest deduction. It's up to $10,000. It starts this year in 2025. It's another non-itemized deduction, so you don't have to itemize to get it. And it doesn't apply to leases, of course, but as long as the auto was assembled here in the United States and your adjusted gross income is below $200,000 married filing jointly, this is a real deduction that could impact you. So kind of fun to know that you can go out and buy a new car and deduct the interest on the loan if you end up financing.
Yeah, perfect. Thanks, Heath. And I think that we'll get to Will and Brian. I wanted to go to Rachel next too. Just kind of staying on the subject of families out there. There's some good news in this bill for families, particularly around the child tax credit and 529s. Talk a little bit about that for us, Rachel.
Yeah, there definitely is some good news in this bill. Similar to some of the things Heath and Brian were talking about, the child tax credit was set to reduce back down to $1,000 effective next year, and that is now not happening. So the child tax credit is actually increasing a little bit up to $2,200. And what's maybe even a more impactful change is that's now going to increase with the cost of living. So that will be something that continues to go up over time that families with kids can take an advantage of and lower your tax bill a little bit. In the same vein, there's some good changes with 529s and HSAs, which families tend to take advantage of as well. So for 529s, kind of two big changes. They really expanded what you can use a 529 for, both kind of before your kid is in college and then even after. So you can start using those funds for more vocational schools, accredited vocational schools, things like welding, even cosmetology school now you can use 529s for. And what's even cool is you can also use them for professional credential programs. So even after graduation, if you're in a career where you need to get credentials, you can use 529 funds for those. And you can use them for CE going forward. So for continuing education, for those credentials going forward, licensing, things like that. So really expanding what you can use 529s for. And then for K through 12, there used to be a maximum where you could only use $10,000 a year from a 529 for K through 12 education. And they've now doubled that limit. So you can use $20,000 a year from a 529 for K through 12. And then they even expanded what qualifies as an expense for those. So you can now use them for tuition. You can use them for SAT prep for your high school students. You can even use them for educational therapy. So really expanding kind of what you can use those accounts for. And I think going back to how that impacts planning, one of the hard decisions that parents have to make is how much do I put in a 529? Because you want to put enough where you have education covered, but not so much that you have money locked up in what can be a restrictive account. And so I think really expanding these uses, both for K through 12 and even college programs, and even after college for professional programs, that will help parents be a little bit more flexible, not so concerned with locking sort of too much money up in a 529, because it really expands what you can use those for. And then the last thing I'll touch on for families is changes to HSAs. So kind of in the same vein, they really just expanded what insurance plans qualify for an HSA. So to be qualified for an HSA, you have to be on something called a high deductible health plan. And they basically expanded the definition for what a high deductible health plan is. And so with the idea that will allow more people to use HSAs, which can be a really great tax benefit. As Heath was saying, that can help if you're close to some AGI cutoff. That's a way to kind of back away from the ledge a little bit and get some money into a health savings account.
And there's one more option out there. Along within the One Big Beautiful Bill, we now have Trump accounts. Tell us, Rachel, what exactly are Trump accounts, and how should our investors approach them?
Yeah, this is probably one of kind of the biggest sort of new shiny things in this bill, because it's a completely new account type in a lot of ways, which is, for us financial planners, it's really exciting because we don't get new account types added very often. And so these accounts are really, really interesting. So they're essentially accounts intended to be sort of a retirement savings account for your child. So they function similar to an IRA is how I would think about it, with a few key differences. So one of the big differences is there's not an earned income limit. So for IRAs and Roth IRAs, you have to have earned income for those types of accounts, and you don't for these. So there's not an earned income limit. What's really cool is for children born 2025, 26, or 27, there's actually going to be $1,000 seed into these accounts. So you even get to jumpstart them a little bit. And you can make up to $5,000 contributions each year. So the contribution limit is a little bit lower than a traditional IRA or Roth IRA, but still meaningful enough to be able to really put some money away in your child's name. So up until 18, there are no withdrawals allowed. And so I would really think about it as a very long-term kind of investment account on your kid's behalf. After 18, you can make withdrawals, but they're similar kind of IRA restrictions. So there's penalties if there are withdrawals before 59 and a half. You can take out your contributions tax-free, but after that, growth will all come out as ordinary income. And so again, I would really think about these as almost jump-starting your child's retirement. And I actually ran some numbers. Again, this is exciting for us financial planners. So I ran some numbers. If you opened a Trump account for your child, say this year or next year, you got the $1,000 seed, and you could max out that account with $5,000 from the year they're born till the year they turn 18. The money's invested within the account. By the time your child's 18, they have more than $200,000 in a retirement account. If they kept that money in there, didn't touch it, no new additions, no withdrawals, they didn't touch it until they were 65, there would be more than $7 million in that account by 65.
Wow.
It's really is
eye-opening. Wow.
And if parents say, hey, maybe I don't have $5,000 of extra cash flow to put toward this, okay, say maybe you can only do $2,000 a year, right? Same scenario, $2,000 a year till 18. They graduate, they turn 18 with $85,000 in this account. And if they don't touch it till 65, they still have more than $3 million in their retirement account. And so, it's a great example that when you're investing, time is the number one thing to have on your side. And so if you can start a retirement account for an infant by the time they're in retirement, it's really just the benefit of all this time and compounding that can really, really benefit them.
And such a powerful example of compounding. It's really, really amazing to see what happens. Most of us never started saving until their 20s at best. And now given the opportunity to save day one is just incredible.
It is, yeah. And what's another interesting piece is there's also some verbiage about employers being able to add into these accounts up to $2,500 a year. So one thing I'm really interested to see if that starts to become a part of sort of benefit packages as people are offered jobs. Hey, we'll put some money into your child's Trump account too. I'm interested to see if that becomes more common.
I love that example, Rachel. That's really just eye-opening to hear that. And so you were talking about retirement, how much money these kids might have. That's a good segue into our Social Security tax rules. Will, I'm going to go to you for this, just for our folks who are looking at retirement, pre-retirement. What do investors need to know about the One Big Beautiful Bill Act in regards to Social Security?
Yeah, well, Rachel just did a great job about all these exciting things, and I'm here to kind of throw a little bit of a wet blanket on the topic. Unfortunately, and probably to the disappointment of many people, taxes on Social Security are not going away. It was a pretty tall task in truthfulness, and there's kind of two main reasons for that. One is, in order to have changed, to have gotten rid of the taxes on Social Security altogether, it would have required changing the tax law, and they would have had to have gotten a 2/3 majority vote in the Senate to do that, and there just was not enough support to do it. So that was a big kind of immediate, slamming the door in the face, if you will, for the likelihood of that happening. The other reason that a lot of people don't talk about and may not be aware of is that the taxes on Social Security actually help fund the program. Now, most of it comes from payroll taxes, right? The taxes that we all pay on our wages, but about 5% does come from the taxes that people pay on their benefits. And if they would have gotten rid of that, that would have removed one of the revenue sources for Social Security, because it is a self-funded program. And so we all know that Social Security is facing shortfall issues in the future. So had they got rid of those taxes, that only would have made that situation even worse.
And there's some new things on the senior deduction too. Can you talk about that, Will?
Yeah, so they did provide a little bit of relief for seniors, people who are over the age of 65. There is an additional $6,000 deduction for single filers, and for married filing jointly, they can get up to $12,000. It doesn't matter if you take the standard deduction or if you itemize, you're still eligible for that, assuming you are not in the income phase outs. So for single filers, if your income exceeds $75,000, then that deduction does begin to phase out. For married filing jointly, if it's above $150,000, then that's where the phase out kicks in for them. And kind of like with some of these other provisions, it is short term. It's in effect for this year, 2025 through 2028, but then after that, it will go away.
So taxes on Social Security stay, but there's a kind of a workaround. I guess are you saying that's Congress's attempt to kind of throw a bone in there to offset the cost for most Social Security receivers?
Yeah, so the taxes on Social Security remain the same. The income thresholds, they've never been adjusted since they were put in place back in the early 1980s. So, and that was kind of done by design, that as time goes by, more and more people would be paying taxes on their benefits, because again, that kind of helps, fund the program, right? Most of our taxes go to the government to fund, the government's operation, but these actually do get diverted back to Social Security. So, and being that was kind of a big campaign promise from the Trump, administration, like you said, they wanted to be able to throw people a bone, try to give some tax relief to our seniors. And, just like anything, like we've seen with this bill in general, is that, there's these provisions that are short term. It's very likely that they may look to try to extend these as those deadlines come through. But as of now, it's until 2028.
One quick point on this, I think, too, that's important. Again, we kind of look at this through the lens of planning. How can we take the information that we've just gotten and try to plan around it? And so one of the things that Will brought up are these phase outs. And in the same way that we might want to be careful about income with relation to the SALT deduction, we also want to be careful about crossing over those thresholds for the senior deduction. So an example might be a client who's really aggressively doing Roth conversions. We might want to try to dial that in a little bit more tightly to try to make sure that we don't inadvertently get rid of a substantial senior deduction by doing a big Roth conversion. So those are the kinds of planning things that I think you're going to see come into play.
Yeah, and I would say too is that a lot of times, the timing of Social Security is such an important thing for a lot of people. And usually the need for income is the biggest driver of that. But if someone's 65 and they're thinking about maybe filing for benefits, to your point, that's more income that's going to be in the picture that could potentially push them into that phase out range. So that could be a decision for some people to say, hey, what if I push this off to maybe 67 when I'm going to get to my full retirement age? I'm going to get a bigger benefit if I do that. If I don't have a strong need for the income, and because this is a short-term window in terms of when this additional deduction is going to be in place, that could be another reason to say, hey, I might kind of put that decision off. So that'll give me kind of some tax relief here for at least for the first couple of years.
That's great. Thanks, Will. And I think, another strategy here that comes into play is estate gift tax planning, charitable giving, perhaps maybe, underutilized or overlooked one, but there are some updates and changes to both those topics. And Brian, what should our investors know about the impact to their planning with these topics?
Yeah, I think the estate planning has been an area of uncertainty really for a number of years because so many of the lifetime exemption amount has been really kind of an uncertain number. And so as estate planners are trying to build these plans, that number that having been in flux for so many years has created kind of the uncertainty and create a planning challenge. So when we talk about, maybe just to back up, when we talk about what is the lifetime exemption, that's an important term to make sure we all understand. So that's referring to the amount that someone can transfer at their death without paying estate taxes. So that exemption amount is really important. And if you pass an amount that's over that exemption amount, the estate tax rate really jumps very quickly and can be as much as 40%. So that number is a very important number from a planning perspective. Prior to the bill being passed, we talked a little bit earlier about sunsets. That lifetime exemption amount was going to roll back to $7 million per person for individuals and $14 million for a married couple. And so with the passing of the One Big Beautiful Act, Big Beautiful Bill Act, that exemption amount was made permanent at $15 million per person or $30 million for a married couple. So what that means is that for most of our clients, the federal estate tax is just not going to be an issue. It's very rare for a married couple to have an estate larger than $30 million. So for most people, the making permanent that lifetime exemption amount and then indexing it with inflation means that estate taxes really just aren't going to be a concern for a lot of people. So again, it creates a lot of clarity. And now we can really do, I think, more detailed estate planning than maybe what we were able to do before, because again, that lifetime exemption amount is pretty much locked in now.
The gift tax is such a confusing thing for a lot of people, and because there's kind of this annual limit each and every year, and people think that if you give more than that, then you're going to have to pay taxes. But Brian, to your point, it's really you've got as we like to say, you kind of have this bucket that is buffered against estate taxes. And a lot of times, though, with that uncertainty about whether it was going to shift back to that relatively lower amount compared to what it's been, that did give people a little bit of pause in terms of like, how do I give if I want to give money to my kids or my grandkids, but without eating too much into that if that amount does kind of shift backward. Now going forward that this is locked in, I think it gives people a lot more room and a lot more comfort to potentially be able to want to give larger gifts during their lifetime to their family members, to their kids, to their grandkids, without having to worry about potentially facing estate taxes because that number is just so high.
Yeah, that's a great point. Another big area that I think saw some changes really pertains to charitable giving. And there were two areas that I want to focus on that I think maybe would impact most of our clients. The first is that under current law, people who don't itemize deductions really don't get any tax benefit for charitable gifts. And because the standard deduction is so big, that has really reduced the number of people who itemize deductions at all. And so for people who are giving to charities, there's sort of a feeling of, well, I'm giving to charity and I'm not able to do anything with that from a tax deductibility perspective. But starting in 2026, taxpayers who don't itemize their deductions, who take that standard deduction, will be able to deduct up to $1,000 if they're single and $2,000 if they're married filing jointly for cash contributions to public charities. So this doesn't include clothing and furniture, non-cash gifts, things like that. This is an actual cash donation, and it is again to a public charity. So if you were putting money into a private foundation or a donor-advised fund, it won't qualify. But if you're giving cash donations to a public charity starting in 2026, even if you don't itemize, you'll be able to take a deduction on those gifts up to $2,000 for a married couple. So planning, in terms of a planning idea, here we are kind of toward the end of the year. If you're planning to give a large cash donation to a charity between now and year end, and you don't itemize your deductions, you might consider waiting to make that gift on January 1st so that you can then deduct that gift in 2026. So again, from a planning perspective, knowing what you have available in terms of deductions can really kind of help come into play.
Such a great point, Brian. And it kind of reminds me of the larger point, too, that so much of the planning that we do around taxes is about placing charitable giving in the right year, also pulling income into this year, pushing it into the following year. There's a lot of that kind of gameplay that happens because of these phase outs and income limitations and everything that exists. So what we do for our clients is we do a full-blown analysis of a tax return. Obviously, we don't know what this year looks like exactly, but we do know what last year looked like. And we can run hypothetical scenarios for this year to see how close we are to these phase outs, or if it makes sense to contribute to charitable causes this year versus versus the following year. And so I would just say to you, whoever's watching this video, if you have questions about when to contribute to charity or whether or not to push income or pull in income into one year or the next, let us take a look at your tax return. Let us run some scenarios to see if we can optimize things.
So Heath, along that line of pulling income into a particular tax year, one thing that I think might also be worth talking about is another change related to charitable giving, and that has to do with a new floor on adjusted gross income. And so for higher income earners in particular, there are two changes that might have an impact. And the first is that there is now a 0.5% floor that is applied to charitable gifts that is 0.5% of your adjusted gross income. That amount is not deductible as your charitable contribution. So to kind of put some numbers to this, let's say that you have adjusted gross income of $100,000 and you make a charitable donation for $5,000. The first $500 or 0.5% of $100,000 would not be deductible. So that means that instead of deducting the $5,000 gift to charity, you would deduct $4,500. So it's not, in this example, it's not the end of the world, but it does reduce the amount that you're able to deduct. Another limitation that's worth noting is, again, particularly for high income earners, is that there is now a cap on charitable deductions of 35%. So if you're in the 37% tax bracket, the highest marginal tax bracket, and you donate $100,000, let's just say, to charity, then under the current tax law, you would be able to deduct $37,000. So that's 37% of my $100,000 gift. But under this new capped limit, capped at 35%, my deduction would be $35,000 instead of $37,000. So again, not the end of the world. It might not necessarily dissuade you from making a charitable contribution, but it is going to reduce the amount that you can deduct. So to your earlier point, Heath, about pulling income and making decisions in one tax year versus another, those limitations don't exist in 2025. So for someone who's planning to make a large charitable contribution, it makes a lot of sense, if possible, to try to do that this tax year so that you're not subject to either the 0.5% AGI floor or the 35% income cap. So again, that's a planning thing that we could consider, and that a really great use case for a vehicle like a donor advised fund. And we can really get into a lot of detail about how those work maybe in a future webinar. But there are a lot of great vehicles out there that clients can use to take advantage of those deductions this year.
Student loans that have been a hot news topic here for several years. How have those laws changed, Rachel?
Yeah, so actually a lot of changes coming to student loans. That's another area of the tax code that did see a big shift with this bill. So a couple really big changes. The first is that the income-based repayment plan is changing. So SAVE is one that a lot of folks have heard of. That's been, to your point, Matt, kind of tied up in the media a lot recently. So that is going away, and it's being replaced with something called the Repayment Assistance Program, or RAP, because they love their acronyms in the student loan world. So RAP is similarly an income-based repayment plan, but the calculation is just a little bit different. So essentially, your payments increase as your income increases. Basically, they're a percentage of your income, and it can go all the way up to 10%. So depending on kind of where income lands, this could see student loan payments for a lot of folks increase, which is tough news for a lot of people because nobody loves paying on their student loans. But the other side is on the sort of standard repayment plans, which function a whole lot more like a traditional loan where you have a balance, you have an interest rate, you have a term, and it's calculated that way. So there's some adjustments coming there too, where higher balances on loans can have longer terms. So if you graduate from medical school and you have 6 figures of debt to put you through medical school, can now kind of extend out paying on a standard repayment plan a bit longer than you could have before. There's also some changes to plus loans. So in the past, you could get a grad plus loan, and those are going away. They're also changing parent plus loans a little bit. So parent plus loans will continue to exist, but they're going to be capped at $20,000 per year per student, and then maxed at $65,000 per student. So they're kind of limiting how much debt parents can get into from at least a federal loan standpoint on the plus loan side, and then really just doing away with the graduate plus loans. There is some time until all of this happens. So the repayment assistance plan will roll out next July, so July 2026. And for current borrowers, they have until 2028 to transition to a new plan. So there's still some time to kind of get your arms around what are the new options, what's best for me, but it's definitely something to be thinking about, particularly as those new plans become available next summer, to see what's the most advantageous way to pay back student loans.
Well, I want to thank Will, Heath, Rachel, Brian for their expert analysis and insight on this webinar. I learned a lot just from being here, and we hope you did too. Whether you're a current client, a future client, Financial Synergies is here for you. We're going to be able to put together your financial game plan, pull all of this complicated information, not just from this act, but just broadly, finding ways to simplify your financial life. We're here for you. You can contact us by visiting our website, finsyn.com, and be sure to follow us on social media. Thank you again for watching. Have a great one.